Hey, everyone! Welcome back to the channel where we break down complex tax strategies into simple, actionable steps. Today, we're diving into the world of raw land investments and how you can maximize your tax deductions. Whether you're a seasoned investor or just starting out, this video is packed with tips to help you save money on your next tax return. So, let's get into it. First, let's start with the basics. Investing in raw land, meaning land that is unimproved and has no buildings, can be a great entry point into real estate. It's typically cheaper than developed properties, and you avoid the hassle of maintenance and tenant management. But when it comes to tax benefits, raw land doesn't offer as much as improved properties. However, there are still some key deductions you can take advantage of. For instance, you can deduct property taxes and interest on loans used to purchase the land, but you'll need to itemize these deductions on your tax return. Let's break down each of these in more detail. Property taxes on raw land are deductible as an itemized personal deduction on Schedule A of your tax return. The great thing is that this deduction is not subject to the $10,000 limit imposed on property taxes for your main or second home. So, if you're paying $5,000 in property taxes on your raw land, you can deduct the entire amount. For example, let's say you paid $15,000 in property taxes on your personal residence and $5,000 on your raw land. While the deduction on your residence is capped at $10,000, you can fully deduct the $5,000 from your raw land on Schedule A. That's an immediate tax benefit for you. Now, let's talk about interest. If you've taken out a loan to purchase your raw land, the interest you pay on that loan is also deductible as an investment interest expense. However, this deduction is limited to your net investment income for the year. To figure out your net investment income, subtract any investment-related expenses from your investment income. Investment income includes things like taxable interest, ordinary dividends, and short-term capital gains. If your investment income is less than the interest you paid, you can carry over the excess interest deduction to future years. For instance, if you have $2,000 in investment income and $1,000 in property tax expenses, your net investment income is $1,000. You can then deduct $1,000 of your interest expense this year and carry over the rest to next year. What about other costs like legal fees, insurance, or even the cost of preparing the land, such as grading or clearing? Unfortunately, under the Tax Cuts and Jobs Act, TCJA, miscellaneous itemized deductions for these types of expenses were eliminated from 2018 through 2025. But here's the kicker: these costs can't even be added to your land's basis. So, these expenses don't give you any tax benefits during this period. It's a bit unfair, right? But you can still capitalize on certain costs, like property taxes and interest, by adding them to the land's basis if you don't itemize deductions. This can reduce your taxable gain when you eventually sell the property. For example, if you bought a lot for $10,000 and capitalized $2,000 in carrying costs each year for 4 years, your adjusted basis in the land would be $18,000. If you sell the land for $20,000, your taxable gain would be just $2,000, potentially saving you on capital gains tax. Finally, let's talk about the passive loss rules. Generally, holding raw land for investment isn't considered a rental activity or a trade or business, so it's not subject to passive loss rules. This means you can't deduct passive activity losses from your salary or portfolio income. However, if you're a developer holding land for future development, this could change, and the passive loss rules might apply. But for most investors, buying raw land for appreciation isn't considered a passive activity, so you don't have to worry about those rules. Alright, let's wrap up with some key takeaways. First, remember that property taxes and loan interest on raw land are deductible, but only if you itemize your deductions. Second, be aware that many other costs, like legal fees or land preparation, aren't deductible under current tax laws. And finally, if you don't itemize, consider capitalizing your costs to reduce future capital gains tax when you sell. Thanks for watching. If you found this video helpful, give it a thumbs up, share it with fellow investors, and subscribe for more tax-saving tips. Got questions? Drop them in the comments below. I'm here to help. See you in the next video.